Two things happened in the same week that Trump really does not want you to connect. Wall Street officially stopped treating U.S. Treasury bills as the world's safest investment, and Canada approved the largest nickel deposit in North American history. The United States needs both of those things. Guess what? They have neither.
And here's what makes this story different from every other financial headline you've seen lately. This has nothing to do with tariffs, nothing to do with Trump's political theater. This is about institutional money, the kind that doesn't care who's in the White House. It's quietly walking away from the United States and looking for somewhere more competent to park several $100 billion.
So where did it go? Well, we're going to show you, and the answer is going to make some very important people in Washington extremely uncomfortable. Canadians and Americans, you need to pay attention to what's going on here.
So let's start with what Moody's actually did recently, because it was the last step in a 14-year process. The S&P downgraded the United States in 2011. Fitch downgraded the United States in 2023. Moody's completed the set. All three of the major credit agencies on Earth have now independently looked at the same books, run the same numbers, and issued the same verdict. The USA is just not a safe investment anymore.
And to understand why the trifecta matters, you need to understand what these agencies actually exist to do. Their entire job is to tell the world's institutional investors how safe a borrower is. And all three of them arrived at the exact same conclusion. The United States is no longer in the top credit tier. That process is now complete, and it's unanimous.
When S&P cut them in 2011, Washington could point to Fitch and Moody still holding the top rating as a kind of narrative insurance. When Fitch cut them in 2023, they could still say, well, Moody still has us at the top. Well, now that argument is gone. There is no agency left on the planet giving Washington a clean bill of financial health.
And Moody's was specific on why it downgraded the U.S. They cited the $36 trillion debt load. They cited consecutive administrations, not just one, a consecutive, plural here, failing to implement any credible plan to close the gap between what it spends and what it takes in. They specifically flagged that interest costs are on track to consume 30% of all federal revenue by 2035. Moody's had the U.S. on negative watch for years. They were watching to see if the U.S. would actually do anything to change that trajectory. It didn't. So they moved and downgraded them.
The bond market, for its part, had already been pricing this in before the announcement. The 30-year U.S. Treasury yield hit 5.27%, a 19-year high. The 10-year settled at 4.75%. Those aren't the numbers of the world's safest borrower. Those are the numbers of a country that investors are now charging a risk premium to lend money to. When your lenders demand more compensation because they're less confident you'll be good for it, well, that's the market's version of a big downgrade.
Yeah, so the verdict is unanimous and the markets are already moving. The first domino is down, and the question now is, where is this serious long-term capital actually going to go? And the answer to that has landed in the Canadian bond market in a way that's very hard to look at without raising an eyebrow.
I'll raise my eyebrow right now.
Okay.
So when institutional money loses confidence in U.S. Treasuries, it doesn't just sit there. It has to move. You can't leave several $100 billion in a downgraded bond that is yielding less than what you can get somewhere more stable. So where did they actually go, Dave?
They went to Canada. In the first 5 months of 2026, foreign investors put 112 billion Canadian into Canadian securities. In April alone, just 1 month, they bought a record $27.7 billion in Canadian federal government bonds. In the first quarter of this year, foreign investment in Canadian bonds hit a record $78.6 billion. That is a signal of how the market sees Canada.
And the reason is not complicated, everyone. Canada's 10-year government bond yield is about 3.7%. That's more than a full percentage point lower than the U.S. Treasury. But Canada's credit rating? The highest possible from Moody's, S&P, and DBRS. And Canada's federal debt to GDP is sitting at about 41%. Compare that to the U.S. at 101%. They're not even playing in the same game.
No, Mark Carney ran the Bank of England. He ran the Bank of Canada. He cut Canada's interest rate to 2.25%. While the U.S. was still fighting inflation with high rates, Canada grew 3.4% in Q2. We covered that yesterday. That's more than double the U.S. growth rate for the same quarter. And 77% of Canada's exports are now heading to Asia. The pivot away from the U.S., this was not an accident. It was deliberate. And right now, it's paying off for Canada.
Yeah. So what you have is a country with a triple-A credit rating, positive GDP growth, low debt, low borrowing costs, and a trade strategy that is diversifying away from the USA. This wasn't just luck. This is what happens when a government actually manages its books instead of just signing executive orders. Carney is a banker after all, and Trump is a crook.
And Wall Street? It can read those books, right? The spread between U.S. and Canadian bonds has been widening for months. You probably never even heard anything about it. Probably because institutional investors, they don't wave flags and yell at the top of their lungs. They just move money quietly in enormous amounts to wherever the math is better. And the math right now says Canada is a better bet. There's no doubt about that. And you know that is driving Trump absolutely insane.
And then this week, Canada went and approved something that turns a financial story into a permanent strategic one. 2 days ago, Canada approved the Crawford Nickel Project in Northern Ontario. And if that name doesn't ring a bell yet, it will, and it should.
Crawford is sitting on the world's second largest nickel sulfide deposit, $5 billion in investment. More than 40 years of operation, and over that lifetime, economic analysis puts its contribution to the Canadian GDP at $70 billion. That is just one mine, fast-tracked and approved 2 days ago.
Now, why does nickel matter in 2026? Well, because the United States, they're desperate for it. You need nickel for electric vehicle batteries. You need it for military-grade stainless steel. You need it for semiconductors inside the U.S. defense technology. Russia controls a huge share of the global supply, and Indonesia, they control most of the rest. And the U.S., they've been trying for years to build a North American critical mineral supply chain, because depending on Russia for materials that go inside your own military hardware, well, to put it politely, it's a problem that they created for themselves by electing Trump.
And while Washington was spending months threatening Canada with tariffs on steel, softwood, and everything else under the sun, Canada was permitting the mine. The leverage didn't shift in a negotiating room here. It shifted on the ground in Northern Ontario, 500 kilometers from the U.S. border. So while Trump was busy navel-gazing, starting a war in Iran, and blowing up drug boats, Canada was taking the first steps in securing partnerships that matter to its own future.
And don't forget cozying up to Putin. And Crawford is built to last in a way that cannot be replicated or reversed. The Taykwa Tagamou Nation put $20 million of their own capital directly into the project. That's a community with genuine financial skin in the game, and this is a 41-year operational partnership. The U.S. cannot find a comparable North American deposit because one doesn't exist. It cannot buy into Crawford on favorable terms after a tariff war, and it cannot threaten its way in. Those days are long gone. So Crawford will still be producing critical minerals in 2065 without the USA.
So let's put the whole picture on the table here. Washington has been downgraded by every major credit agency on Earth. Its bond yields are at a 19-year high. It's spending $1 trillion a year just on interest with no credible plan to stop. And the institutional capital that used to sit in U.S. Treasuries is now sitting in Canadian government bonds. And also, at the exact same moment, Canada has locked up the critical mineral deposit that the U.S. defense and technology industries can't function without. The financial door here is closing, and the resource door, well, it just closed. Sounds like America's winning to me, right?
Not at all. Listen, you can wave whatever flag you want. You can argue about whoever you want. The bond market really doesn't care. The mining companies, they don't care either. The institutional investors who put $112 billion into Canadian securities in 5 months, They are not watching the news to decide what to do. They're reading the financial reports, and those reports are telling a very clear story. The math is not on Washington's side. It's on Canada's.
So here's our question for you today. Washington is now carrying a $36 trillion debt load, a credit rating that's no longer at the top tier at any of the big three agencies, and a critical mineral supply chain that just moved further out of reach. At what point does the conversation in Washington shift from threatening Canada to actually negotiating with Canada?
Drop your thoughts in the comments below and check out the pinned comment while you're down there with all the links to the fun stuff like Substack, the Facebook group, our merch store, and the A-Team.
And don't forget to give this a like, a hype, and a share so other people can see how horribly the US is doing right now.
Thanks for watching, everyone, and we'll see you tomorrow with some more, hopefully positive news.
Ciao for now.